All right, let's just jump right into it. If you've been looking at the US economy lately, you're probably seeing some wildly mixed signals. I mean, on one side, you have Wall Street throwing a party with record-breaking markets. And on the other, Washington is at a complete standstill thanks to a government shutdown. It's a real head-scratcher. And today, we're going to try and piece this puzzle together.
And this slide right here, it just lays the whole contradiction out perfectly. In one corner, you've got the big leagues, the S&P 500, the NASDAQ, the Dow, all hitting brand new all-time highs. Investors are feeling good, right? But then you look at the other corner and the US government is literally on its third day of a shutdown. Gridlock is the name of the game. So the big question is, how can both of these things be happening at the same time?
And that's really the core question we're tackling. What is the actual story with the economy? Are the markets right? Are they seeing something great on the horizon? Or is this shutdown a sign of some really deep problems that the markets are just ignoring? To get to the bottom of it, we have to look past the flashy headlines and go straight to the economy's engine room, the bond market.
That's right, we are talking about US Treasury yields. Now I know, they're not as exciting as stock prices, but trust me, they are one of the most powerful signs of what the smartest people with the most money are really thinking about our economic future. They tell a story about everything, growth, inflation, you name it.
So if we look at the numbers from October 3rd, everything seems pretty normal. You know, the longer you're willing to lend the government your money, the higher the interest rate or yield you get. Makes sense. You'd expect a bigger reward for locking up your cash for 30 years compared to just 2. But this little snapshot, it's deceiving. The real story isn't in these numbers today, but in how they've been behaving over time. To get that real story, we have to look at the relationship between these yields, which is something called the yield curve. And for decades, this has been one of the most reliable, maybe the most reliable predictors that an economic recession is on its way.
And here is the big idea, the inverted yield curve. This is when that normal relationship we just saw completely flips on its head. Suddenly, you get paid more for a short-term bond than a long-term one. Now, why on earth would that happen? Well, it means investors are so nervous about the economy's future that they're scrambling to lock their money away for a long time, even if it means getting a lower return. It is a massive vote of no confidence.
And look, this isn't some fringe theory cooked up on the internet. The difference between the 10-year and the 2-year Treasury yields, what they call the 10-2 spread, is widely seen as one of the best leading indicators we have. When that thing inverts, it's like a countdown clock for a recession has just started ticking.
And here's the kicker. That yield curve, it was inverted for a very long time. We're talking from July 2022 all the way to August 2024. That clock has been running. And historically, recessions tend to hit anywhere from 18 to 92 weeks after the inversion starts. So where are we today in October 2025? Yep, we are right in the middle of that warning window. The signal has been tripped.
But, okay, hold on. It's not as simple as just saying a recession is definitely coming. The picture's way more complicated. There's a lot of conflicting data out there that has sparked a huge debate about whether maybe this time is different.
And this slide really breaks down that debate. On one side, you have analysts like Jake Shormier saying, hey, the economy's actually strong and inflation is still high, so yields should stay up. But on the other side, the markets are placing massive bets that the Federal Reserve is about to start cutting interest rates, which is something they usually only do when the economy is slowing down.
And we're not just guessing here. The CME FedWatch tool, which tracks all these market bets, shows there's an overwhelming 85% chance of 2 more rate cuts by the end of the year. The market is basically screaming that it expects the Fed to jump in and save a weakening economy. That just does not line up with the everything is strong story.
And, as if that wasn't confusing enough, let's throw the government shutdown into the mix. This is way more than a political headline. It's a giant economic wrench thrown into the gears of an already complicated machine, and it is having very real consequences.
Treasury Secretary Scott Bessent didn't mince words. He warned that this shutdown will directly damage the economy. He's talking a hit to our GDP, a hit to growth, and most importantly, a hit to regular working people. This is not a theoretical problem. It has real, tangible costs.
But here's the bigger, more immediate problem. The shutdown has created a data blackout. The agencies that give us all our economic information have basically had to turn the lights off. That means we're not getting critical reports like the September jobs numbers, weekly jobless claims, or factory orders. We've lost our eyes and ears on the economy.
So what's the bottom line here?
It means the Federal Reserve, the single most important group responsible for steering our economy, is now trying to make its next critical decision with less information. They are essentially flying with less visibility, right at the moment when we need clarity the most.
So, after looking at the flashing red lights from the bond market, the contradictory bets on what the Fed will do, and the total chaos from the shutdown, where does this all leave us? What should you be taking away from this?
Well, it really boils down to three huge things to keep an eye on. First, that yield curve. Does the old recession warning still hold true this time around? Second, the Fed. Are they going to do what the market expects and cut rates? And third, the shutdown itself. When is it going to end, and when will we finally start getting that crucial economic data back?
And that really brings us to the final unsettling thought. We are in a bizarre and deeply uncertain moment. The economy's most trusted warning signals are flashing red, telling us to be careful. But at the exact same time, the government shutdown has switched off our instruments. So it leaves us with one pretty critical question. What happens when the markets are partying like it's a smooth flight, but the people in the cockpit know there might be a storm ahead, and they have to fly blind?